Welcome back to the Wall Street Podcast. Today, we're diving into a recent Goldman Sachs Global Investment Research report. It's called USD versus EUR spreads. Both rich, but one more at risk, and it just came out August 7th, 2025. It digs into some significant shifts in credit markets, macroeconomic influences, basically insights relevant for your investment thinking. Our job here is to pull out the key takeaways for you.
Exactly. And the big headline is Goldman shifting its view on EUR versus USD credit spreads. They've moved to overweight EUR, up from neutral back in May. It's really about these diverging growth pictures. The U.S. outlook has, well, weakened a bit, while Europe's actually seen some improvement.
Okay, so when you say the U.S. outlook has deteriorated, how significant are we talking? Is it a minor adjustment or something more concerning?
Well, the report points to the July employment numbers. They use the term thicker left tail for U.S. growth, which basically means a higher chance of a much weaker outcome than previously thought, a bigger downside risk. Plus, you've got tariffs dragging on GDP. They forecast 1.2% by year-end. And that's expected to keep a lid on real income and spending growth, especially with the job market looking softer.
Right. And meanwhile, Europe's looking brighter. What's behind that upgrade?
Yes. Precisely. The U.S.-EU trade deal actually came in better than expected, so Goldman's European economists bumped their growth forecast up to 1.2% for the year. That's actually above the consensus now. And while, Fed rate cuts are generally good for risk assets, the report argues valuations are pretty tight now, so any boost from cuts might mostly benefit equities, maybe not so much the credit spreads themselves.
Okay, interesting. Let's shift gears to high yield. The report seems quite clear on preferring HY bonds over leveraged loans. Why is that?
There are two main reasons highlighted. First, the carry duration on high-yield bonds is seen as superior. Basically, you get a better yield for the interest rate risk you're taking. Second, loans have what's called negative convexity.
Negative convexity.
Yeah.
Meaning they lose value faster when rates fall.
Exactly. They don't gain as much when rates rise compared to how much they lose when rates fall. And with the Fed expected to cut rates, they're penciling in 3 25 basis point cuts between September and December this year, plus 2 more in early 26.
Right.
That expected drop in rates really eats away at the yield advantage loans traditionally have. It makes bonds look, well, more attractive, relatively speaking.
Got it. Now, the report also downgrades CCC-rated bonds to underweight. What makes them particularly vulnerable right now?
This is quite critical. It's mainly about refinancing needs. About 14% of the total face value, the notional debt for CCCs, is maturing within the next 2 years. That figure is actually double the average we've seen since 2009.
Double. Wow.
Yeah. And on top of that, yields have widened by about 40 basis points. So their borrowing costs have gone up. Combine high refinancing needs with higher costs in a sluggish growth environment, it creates a really tough situation, significant penalties for refinancing.
So a double whammy. And within the broader U.S. high-yield space, are they leaning defensive?
Yes, definitely advising caution on cyclicals. Sectors like chemicals, autos, consumer products, they've continued to lag in Q3, whereas a defensive sector like pharma has actually outperformed. So it reinforces that preference for defensives over cyclicals right now.
And one last point from the report, European demand for U.S. credit slowing down. What does that signal?
It signals a shift, yeah. The fund flow data suggests European investors aren't pulling out entirely, but they are allocating new money more evenly. It's more of a balanced approach now between USD and EUR credit. This balancing act for that marginal dollar affects demand, potentially liquidity and pricing for U.S. fixed income.
Okay, let's try to connect some dots here. Why is this move to overweight EUR spreads seen as such a key call from Goldman?
Well, I think it underscores a focus on managing downside risk. You have that thicker left tail for U.S. growth, the weak jobs data, the tariffs, and then Europe gets an upgrade because of the trade deal. So the relative value calculation starts to weigh potential losses more heavily. It suggests a more, let's say, defensive stance in allocating credit risk.
And thinking about those CCC-rated bonds again, beyond the market implications, how might that refinancing pressure directly hit the companies involved, impact their actual operations?
Oh, absolutely. That combination of needing to refinance soon, that 14% figure, and the higher cost, the 40 BP widening, puts direct pressure on their cash flow. It could force difficult choices, cutting back investment, maybe scaling down operations. Worst case, it increases default risk. And that obviously has knock-on effects for their employees, maybe job security, and also for their suppliers, think delayed payments or less business.
Makes sense. And the shift in European flows, if they're becoming more balanced, could that have wider ripples in global capital markets beyond just the immediate USD credit pricing?
It could, yes. It reflects a broader reassessment of risk and value across different currency zones. If European investors are becoming more balanced, perhaps other international investors might follow suit. That could potentially dampen the overall appetite for new debt issued in US dollars. It might mean US companies have to look harder for funding or maybe accept slightly higher borrowing costs, which influences global capital movement and investment strategies.
So, bringing this down to the everyday level, what does this mean for the general public? How might you feel these shifts?
Well, the report suggests a more challenging climate for certain U.S. companies, particularly in those high-yield cyclical areas. That can influence how easily companies can borrow and at what cost. So indirectly, you might see impacts on business investment or even hiring in the U.S. if financing gets tighter. On the flip side, Europe's better outlook, helped by that trade deal, could be positive for trade flowing across the Atlantic. Maybe slightly better prices for some goods, or new opportunities if you're involved in businesses with European ties.
So it really highlights these diverging paths globally.
It does. And understanding these nuances in the credit markets, even at a high level, helps you make sense of the bigger economic picture and how it might affect investments or even just the economic environment around you.
Absolutely.
Yeah.
As these global economic stories unfold differently, grasping what's happening in credit is vital for seeing both the risks and the opportunities ahead. We hope this deep dive gave you some useful perspective.